Hello everyone, this is your host Vivek Somani from OptionGig, and in today's video we're going to talk about beta weighted delta and how knowing your portfolio beta weighted delta can help you in managing the overall risk in your portfolio. So this topic is for advanced traders who are now looking at the overall portfolio and not just at individual holdings. Okay. Alright, so let's dive right into it. So now in this particular presentation, we're gonna look at beta, we're gonna look at delta, and then we will also consider how we can find out the overall delta of your portfolio using these concepts. Okay. So first concept we're gonna dive into is beta. So let's understand what is beta. Beta is a measure of your stock's volatility in relation to the overall market. Now the market could be any widely traded representative of a market ETF. It could be SPY or it could be anything else. The beta of a particular stock measures how much is the stock volatile as compared to an overall market. So by definition, the market itself has a beta of 1. Now examples of high beta, a stock having a beta of 1.5 means it is 1.5 times more volatile than market. For example, if the overall market goes up by 5%, then the stock could go up by 7.5%. If a market goes down by 5% points, then this particular stock could go down by 1.5 into 5 or 7.5%. Okay. So you would see that the changes in the stock value is higher than the changes in the market because it is a high beta stock. An example of high beta stocks, an AMD, it has got a beta of 4, Splunk has got a beta of 1.67. You would generally see that the new tech high growth companies have a much higher beta because they are more volatile than rest of market. Now examples of low beta, for example, if a stock is having a beta of 0.5 means it is half as volatile as market. So if a market goes up by 10%, this particular stock which has a beta of 0.5 will go up only by 5%. Conversely, if a market goes down by 10%, this stock is expected to go down only by 5%. So both the upsides and the downsides are subdued. They are half of what we would generally expect a market to do. Low beta examples, let's say XLU, which is a utilities ETF, XLP, which is a consumer staples ETF, HYG, which is a corporate bonds ETF. They are lesser volatile than the broad market. Now again, I would like to refer that the broad market here we consider is generally SPY. So these ETFs will not have the huge up or down swings as you would see in a market because they have a lower beta. They tend to move slowly either in upward direction or in downward direction. Now we looked at the individual stocks and their beta. What if you have more than one stock in your portfolio? So using a beta of individual stocks, it is feasible to calculate the beta of your overall portfolio. Right? Now, the weighted average beta is calculated for entire portfolio because each of the stocks will contribute to the overall portfolio beta based on how much weight or how much is its total value as compared to your portfolio value. So that is why you should take a weighted average of beta. Okay. So this process is called beta weighting of portfolio. So portfolio beta, once you know your overall portfolio beta, that will help you to understand how volatile is your portfolio as compared to overall market. Right. Most of the broker platform already show this value, so you do not have to manually calculate it, but just make sure you understand that when you're looking at a portfolio level beta, it will tell you how much your portfolio is volatile as compared to overall market, right? So if a portfolio beta is greater than 1, that means your portfolio is more volatile than market, right? If let's say if your portfolio beta is 2, it means if a market goes up by 5%, your portfolio could be expected to go up by 10%, or it could be in the reverse direction also, that if market goes down by 5%, your portfolio could decrease by 10%. Portfolio beta less than 1 means that it is lesser volatile than the overall market, right? So just understand this concept, and summary is that beta indicates the volatility of your portfolio as compared to overall market. Higher the beta, more volatile the portfolio is. Lower the beta, lesser volatile the portfolio is. Okay. Now let's move on to the next important concept, which is delta. Now, delta is the amount of change in the value of either option or a stock for every $1 change in the stock price. Right. Now we will look at a stock delta as well as option delta both. So first look at an option delta. So if the delta of an option is 0.25, then for every $1 move in the stock price, the option price will move 25 cents, because delta is the amount of change in the value of an underlying, whether the underlying is option or the underlying is stock, for every $1 change in stock. So if it's 0.25 delta, then for $1 change in the stock, the option price will change 25 cents. If the delta is minus 0.25, then the option pricing will change by 0.25, but in the opposite direction of the stock. So remember, delta can be positive or delta can be negative. So if it is positive, means the price will change in the direction of the stock movement. If a stock goes high, the option price will go high. If it is negative, means the price will change in the reverse direction of a stock movement. If a stock goes higher, the option price will go lower, because the option price has a delta of minus 0.25. Right? Now by definition, the delta of the stock is 1, because if a underlying stock moves up by $1, your portfolio, which has only stock, will move up by $1. So the delta of option, that will vary depending on how far the option strike price is from the current strike price. Essentially, farther you go from a current stock price, lower is the delta of that option. So let's take an example. So in this chart, you can see on the right hand side, we have a delta of puts which are negative. On the left hand side, you see the delta of calls which are positive. Now currently the stock is trading at approximately $29. So as you go away from the stock price, in the put case, as you go out the money, the delta starts to decrease, right? You go at 27, 25, the delta is negative 0.21, 23, the delta is negative 0.10. But if you go same on the call side, as you go out the money, the delta starts to decrease. The at the money delta is approximately 0.48. Then if you look at $32, the delta is 0.27. If you look at 35, the delta is 0.13. So for puts, the delta is negative. For the calls, the delta is positive. Okay. So this is how the option delta is mentioned on a broker platform. Now, if you are holding stocks, the delta of a stock is always 1. So portfolio delta measures how much is your overall portfolio will change by $1 change in an underlying holdings. Okay. Now we will take some examples of what may be in your portfolio and how will that change by change of underlying. Examples. Let's say if your portfolio has a shares 500 shares of AMD, then the delta of your portfolio is 500, because if AMD moves up by $1, your portfolio value changes by $500. Hence, the delta of your portfolio is 500 because you have only one share, which is AMD. Let's say if you have instead of having a stock, you have an option. So the example we are taking is that your portfolio has 500 long call option of AMD at a strike price of 30. So at a strike price of 30, the delta of this option is 0.40. So your overall portfolio delta is 0.40 multiplied by 500 equal to 200. Means if AMD rise by $1, your portfolio value will go up by $200. It will not go up by $500 because you are having an option whose delta is 0.4 times. So if AMD rise by $1, your each individual option will only increase by 40 cents. And since you have a 500 call options, the overall increase in your portfolio will be $200. Okay. Different example, instead of having a call, if in your portfolio you have only 500 long puts, means you have bought these puts of AMD at a strike price of 25. Now at a strike price of 25, the delta of this option is negative 0.21. So if AMD goes up by $1, your portfolio will go down by $105, which is 0.21 multiplied by 500 because you have a 500 long puts. So which is equal to 105. But remember, the delta is negative 0.21. It means the pricing of this option will go or will change in the opposite direction of the stock movement. So AMD stock goes up by $1, your overall option price will go down by $105. If AMD goes down by $1, then your portfolio value, which has got 500 long puts, would have gone up by $105. Right? Okay. Let's take an example where we have a mix of the couple of stocks. So let's say your portfolio has 200 shares of AMD and 100 shares of Facebook. Then you have to consider your overall portfolio delta, or the value will change based on the individual constituents. So in this example, if AMD moves up by $1 and Facebook moves down by 1.5, your overall portfolio increases only by $50 because 200 is contributed by AMD, but Facebook moved down by $1.50 and you had 100 shares of Facebook. So your Facebook portion of the portfolio decreased by $150. So the resulting net increase is only $50. So in summary, the delta tells us the direction or the magnitude of the change in portfolio. Remember, it has got both direction and magnitude. If it is positive delta, it means your portfolio value will change in the direction of an underlying which you are comparing it with. If it has got a negative delta, then your portfolio value will change in the reverse direction of the change in underlying. But now the $1 million question is, how do I know what's my overall portfolio delta as compared to an overall market, let's say SPY, right? Most of the broker platforms use SPY as a proxy of overall market. Now we looked at a portfolio which has got AMD and has got FB. But if I were to hedge my portfolio by looking at how the overall market is moving, then I need to consider some ETF or a stock which is representative of overall market, and most of the cases it is SPY. So if you know what your overall portfolio delta is as compared to SPY, this will help you in making a decisions to hedge your risk in the portfolio, because delta will tell you how much is the risk in your portfolio. Okay. So what can we do to come to that information? We need to find out what is your delta, but it needs to be a beta weighted delta. I know this is a little heavy concept, so I'll go a little slow on this one to make sure you have a full understanding of beta weighted delta. We need to find out what is my overall portfolio beta, and then find overall portfolio delta, which will tell us how much my portfolio will change by changing $1 SPY, right? This is the single number which will tell us how much our portfolio will move with $1 move in broad market or SPY. Like I said, while you could choose any broad market index or a ticker, most broker platform use SPY as an indicator. So if your portfolio beta weighted delta is 350, that means if SPY gains $1, portfolio would gain $350. Remember, we are not talking about individual stocks in your portfolio. So some stocks may gain, some stocks may lose. It depends on what's the delta of those stocks is, what's the beta of those stocks is. But once you combine and look at your all the holdings, if you were to find out and consider all the holdings as a SPY holding, that value will tell you that value is portfolio beta weighted delta. So in this case, 350 portfolio beta weighted delta means all the positions, stocks, options eventually amount to 350 shares of SPY in your portfolio. So now as a trader, you immediately know what's your overall exposure as compared to market. It means you are holding an equivalent of 350 SPY in your portfolio. So now we could use this particular information, the portfolio beta weighted delta, to determine what's the current direction of our portfolio. And we can use this information to make a decision on the next trade, or if we want to make a hedging decisions for our portfolio, right? For example, if the portfolio beta weighted delta is too high for your portfolio size, and this vary from trader to trader and how a trader is comfortable. Now let me take an example. Let's say I'm comfortable with holding 300 shares of equivalent of 300 shares of SPY, right? But suddenly I notice that my overall portfolio beta weighted delta is 500. It means I have much more bullish exposure in my portfolio than what I'm comfortable in holding. So what do we need to do? We need to think about that my next trade should be a bullish trade, or I need to hedge my portfolio. Similarly, if the portfolio beta weighted delta is too much negative, means my overall portfolio is bearish, means the overall portfolio will benefit if market goes down, right? That's why it was bearish. So the portfolio beta weighted delta value will tell you how much the directional risk you have in your portfolio. If it is too high, it means you have a lot of bullish exposure in the portfolio. You want, if it is too much negative, then your portfolio is too much bearish, means if market goes low, you will benefit. If the market goes high, you will lose. So it tells us the tilt of our portfolio. Now how can we use that information? If your current tilt is bullish, then we should look for a bearish trades if we have to place a new trade. So let's say if my portfolio beta weighted delta is already 500, then even if an individual trade could be looking very attractive to me, but if it is a bullish trade, I would not do it. What we should do is we should look for a bearish trade. So instead of doing put spread, we should be looking to do a call spread so that we can reduce our overall bullishness in the portfolio to become as neutral as feasible. Conversely, if the current tilt is bearish, then you should search for a bullish trades, means you should search for a naked puts or a put spread. If you know this portfolio beta weighted delta, you could make those decisions. You could put up your hedge trades to, if it is to hedge your current direction of portfolio, right? If your portfolio is too bullish right now because your portfolio beta weighted delta value is too high, sell a naked calls to reduce the bullishness, or sell a naked call spread to reduce the bullishness, right? In many cases, what I do is, if my portfolio beta weighted delta is 500 and I want to reduce the exposure, I would just go and sell some call spreads in SPY, because now I know if SPY goes higher, even though I will lose on call spread, but my overall portfolio will gain, so it will neutralize. Or if a SPY goes lower, my overall portfolio could lose, but then my call spread will reduce that loss. So that's how we can hedge our trades, and knowing your portfolio beta weighted delta can help you in making those decisions. Okay. All right. So I hope this was useful. If you have any questions, you can send it to me at optiongig@gmail.com. And if you liked what you learned, help me spread the word so others can also benefit from it. Okay. All right. Thank you very much.